started. So thanks everybody for joining. I just looked through the list of all the folks on. About 70% of the people on I know, which is fantastic. And we'll look forward to talking you through just what's happening in the market as we see it and what we see for the outlook for next year. We also have about 30 or so investors also on the call, and so I can probably go into more detail with the investors. Albert and I were just discussing what we'll probably do is a separate webinar where we go into more of the financial details and so on for those folks over and above the statements that come from our fund administrator. But more on that anon. I'll do a few minutes of market update. I'll then talk about what our outlook is, because this has been a very, very strange year, and we'll leave a few minutes at the end for Q&A. And then what we did after the last one was we had a number of people come to us afterwards and ask for separate follow-up. So happy to do that. We're all new at this virtual meeting kind of fundraising activity, so we'll figure that out as time goes by. The purpose of this webinar is purely just to update people what we see on the market. This is not a sales pitch, and this is not a solicitation. And it would be remiss of me if I didn't read out this disclaimer on behalf of our attorneys. I'll allow you to read that yourselves, but in short, this investment or any investment comes with risk. There is no guarantee of any return, and any statements about the future are simply estimates, and there's no guarantees, warranties, or any other guarantee that anything that is contained in this presentation will in fact happen as time goes by. So my name is Paul Burkett. I've met many of you. I run Automation Finance. We are a non-performing loan fund. We run a number of different funds, but our specialty is buying non-performing loans and sub-performing loans, which is typically loans where the borrower makes some payments but not all of them. We buy first liens, we buy second liens, we buy all sorts of mortgage debt, but the one thing they all have in common with them is there is some flaw in the loan. And as a result, we can buy that loan at a discount and then use that discount to generate a return for our investors. We have 3 closed funds so far and 1 which we've been really focusing on this year. Our fund so far, we've created about 17% IRR per year. The active fund, the most significant one on the bottom right, is a pool that we've really focused on this year because it's been difficult to buy loans this year. And that pool is producing about 28% a year. I think we'll actually do a lot better than that. But we bought it about 24 months ago for just over $6 million, and it has all returned the $6 million so far. It will probably generate somewhere in the $10 to $12 million in the fullness of time. And so that would be a much higher IRR. We're obviously reducing those numbers to be more conservative. We've been in the market since 2013 and started buying more aggressively in 14 and 15. And we run our own books, but we also manage loans for other people. So we run up to 2,500 mortgages in total, where we do administrative work for our own loans and other loans. Some of the investors are on the call are from our Reperformance Fund number 4, and that is a crowd sourced fund which is SEC regulated. And I started that about a year ago, maybe a little over a year ago. It took a long time to get through the SEC qualification process. And it does essentially the same thing as everything we have done up until to this point. The key features of it are, we target an 8% return, which means there's no guarantee, but we have made about 16, 17% a year on all of the funds that we've done so far. The idea is that we would split that with the investor. We would pay half to the investor as a preferred return, and the rest we would retain for ourselves. So the first 8% from the fund goes to the investor. then the return of the investor's capital and anything that is left would be retained by us as the manager of that fund. The objective is to buy sub-performing residential mortgages, to modify them, which means talk to the borrower, understand why the borrower has stopped paying, and come to an arrangement with them whereby they can start making payments again. The loan becomes then re-performing, can be held for 12 months or 24 months, and then resold. And to look at the example below, we're buying these loans. If the home is worth about $100,000, we're paying about $60,000 for that loan. Now, we're not buying the house, we're just buying the mortgage on that house, which may have had no payments on it for many months, maybe even years. And our job then is to work with the homeowner to avoid foreclosure so that they don't lose their home. And the way we do that is we restructure the loan. So they may be $10,000, $20,000, $30,000 behind in payments. And we can do for that homeowner what a bank or well-known mortgage company cannot do. If you go to your local bank and say, I can't pay my mortgage for a couple of years, there's not much they can do to help you, because if they help you, they have to help every other homeowner on whose home they have a mortgage. And so there would be contagion through their whole book. So typically what the bank will do is, rather than hold that loan on their balance sheet as a non-performing asset, they may sell that loan and they'll sell it to somebody like us. And our objective and our business is in getting that loan, understanding why the borrower stopped paying, and figuring out a way that allows the borrower to start paying again. Typically, that will mean that we will write down the balance of the loan. We may also extend the term. We may also reduce their interest rate. We may waive past due payments. We can do things that a bank cannot do for a couple of reasons. The first is the banks are very highly regulated by what they can actually offer to a borrower, and we are much less restrained in the sort of assistance that we can offer. And the second thing is, we're buying these loans at a discount. Typically, we might get a 40% discount on an average loan. That creates quite a bit of wiggle room or margin where we can discount the value of that loan when we're dealing with the homeowner, so that we can reduce their payment. In theory, we could reduce their payment by 40%. And that's often what we do. In fact, we typically try and modify the borrower, modify their payment, so they're paying roughly 75 to 80% of what they would be paying if they were to rent the home in which they're living. And so that creates a win-win setup for the borrower, because why would they not choose to make a payment on a home that they own, which is most likely appreciating in value? And we'll talk a little bit about appreciating values in a couple of minutes. But that's it in a nutshell. It's very easy to say, but it's a little bit more difficult to do. There are many moving pieces. There's a lot of legal requirements. And it's not as simple as calling up a borrower and doing a deal, but I'm just doing that, giving you that description as an illustration. So when we spoke last, I said that the stage was set for a significant change in the market, and that potentially we could have either things will go back to normal and just be fine, or would we have a redo of 2008? And so then the Fed stepped in, and who knew what they were going to do? But we said there were a couple of areas that were very risky for the market. The first one was second homes, places which were luxury consumption for people. It was also a big risk, places like the expensive Northeast and anywhere that was involved in oil, because the price of oil had collapsed at that time, now partially recovered. And anywhere that was leisure or conference related. And any of you who I know from the conference circuit will have been getting their inbox populated from all of the hotels in Las Vegas that we would typically be meeting in this time of year for the mortgage conferences, with just super attractive offers where they're trying to get people to come back traveling again. And obviously that's a very tough brief for those folks. We said that at that time we had about $2 million sitting in the Reperformance Fund. That's all public. And we were sitting on cash, and we were paying our 8% return to investors out of our own pockets. And the reason we were doing that is because we were very concerned that the price of non-performing loans or sub-performing loans or real estate in general would collapse the way it did in 2008. And so better to pay the money out from our own pockets than to buy loans and have the value of the loans collapse. We were bidding, but we were bidding very conservatively, about 25% below where we would normally have been bidding, let's say in January and February. We suspected there'd be lower prices ahead, and so we said we'll spend the time to really work the deals that we already have much more aggressively to ensure that we maximize any return that we can get from those loans. And we were basically waiting for the other guy to blink. So what happened? Well, what happened was that distress is taking a lot longer to show up in the market. If you remember back to 2008, the crisis happened in 2008, but real estate prices didn't bottom until 2011, the very beginning of 2011. And I think they hit their bottom in May or June of 2011. So 3 years or more of price declines. And I just pulled this literally from today. This came from Black Knight, that shows that there's about 1 million to 1.5 million loans in delinquent across the whole US at any time. And at the moment, it's 3.4 million. That's a highly elevated number of loans, and some of those loans will be worked out, they'll be self-cured, but many of them will not. And even if just 1 million loans or even 1.5 million loans end up going into foreclosure, that's still a vast, vast inventory for operators like us to go and buy those loans from the mortgage companies or the banks. We're just not seeing it happening yet. And the question you're probably asking is, well, why are we not seeing it yet? Well, we are and we aren't. There's some places where we truly are seeing it, and that is in high-priced real estate. All of these crashes show up much more quickly in highly leveraged situations and in high-priced places. So I get across my desk, not every day, but every week, high-priced condos in New York, out in the Hamptons, and in the high-priced cities like Chicago, Seattle, and San Francisco. Deals like this, now they're not as big as this. This is a real headline grabber, but losing $12 million on an apartment over 4 years just gives you the idea of the sort of things that are going on. A lot of these luxury apartments are coming to market, and they're coming to market at much lower prices than they would have been a year ago. This one is a multi-billion one, but just a few weeks ago, we saw one that was a $4 million, 1,800 square foot apartment on Central Park. That would have been $6 million, came to the market at $4 million. So we are seeing some significant cuts in prices and values there. We're also seeing them in San Francisco, and that has rolled over into private label commercial mortgage-backed securities. And I simply say that because it takes a while for those structured investment securities to show up in the market as a loan default. They tend to have they are over collateralized, so they can survive for many months, maybe a year, without collecting the contractual loan payments from the people who are living in these homes. And another example would be in the commercial world. So what this graph shows is, and I'm sorry there's so much on it, but it's just a very interesting graph. And send me a mail after this if you'd like these charts. I'm happy to share them. What this shows is the number of commercial mortgage-backed securities in special servicing. So special servicing is the state that the loan goes to before it goes into foreclosure. So if you're a hotel or in retail, that's the top two lines, or the dotted blue line is the average of all commercial securities. They were trucking along at 2 or 3 or 4% before the pandemic, and now they're up in the mid to high 20s. So hotels and retail really, really struggling, and that has two knock-on effects. apart from the obvious effect, which is that the hotel has no revenue, the room rates are down, and in many cases, particularly in Manhattan, the hotels are still closed. Just doesn't make sense to even open them. But also all the people who are employed in those leisure, lodging and hospitality industry and in retail, those people have been furloughed and are not earning what they were. And one person's income is another person's expenditure, or one person's expenditure is another person's income. And so the whole velocity of money falls. We saw enormous unemployment at the beginning of April into May, and that has now fallen down to about 750,000 people unemployed, a lot better than it got up to almost 7 million people at the peak. And across this period, more than 30 million people, and that's 10% of the entire population, made some sort of an unemployment claim. But if you look at the far right of this graph, it's about just under 1 million people. That's still nearly 3 times what it was back in January, February, March. So you can imagine the implications that has for the economy overall and for earning. So we'll see in the next months, CNBC and other news outlets crying the success of the growth in the economy, because it's up 6-7% a month on month or quarter over quarter. And that's terrific. But we really need to look at the whole year, because if you have a precipitous fall, it takes a lot of months of growth to get back to even where you were before the fall happened. And I think what no one truly expected to happen in terms of what went on in the economy was the level of intervention, not just by the US, but every market around the world. And so what this chart shows is the black dot is how much stimulus as a percent of GDP was spent in the 2008 crisis.
Check this out.
And the blue balloon is how much was spent on coronavirus. So in Germany, they spent 3.5% of GDP. They spent 10 times that amount fighting coronavirus. The US spent 5% of GDP. We're now at 12.1% of GDP. Now, these are obviously enormous numbers, and we're not done yet. If we believe the headlines, there's another 2 trillion to come. So that 12 trillion will be, or that 12% will become about 13.5% when you add the next 2.5 trillion in. That is an unbelievable amount of cash to enter the economy. And as yet, we see absolutely no inflation. That may come in time, but for right now, we see no inflation. What they also did was cut interest rates. So right now, we have the lowest interest rates we've ever seen in the history of the country. A massive stimulus plus super low interest rates. There isn't much more that the Fed, the Fed can do and the Treasury can do to support the economy. Unprecedented and extraordinary. And as a result, it's probably not too surprising to see it starting to show up in housing. So we're seeing more inflation, house price inflation, than anyone would have expected. If I was to say to you in 2020, 30 million people will claim unemployment and home prices will go up 7.2%, you would probably question some of my math at least. But that's exactly what has happened. We've seen enormous price inflation, and even very conservative market commentators, the likes of CoreLogic, at the beginning of the year in March, were predicting that home prices would grow just 1% for the year. They're now predicting 7 or 8%. We'll get onto that in a moment. In fact, yeah, that's the next chart here. They're currently appreciating at about 7.5%. In the same year as 30 million people sought unemployment assistance. And that really is a function of ultra low interest rates. Anyone who has a job and is a renter and has good credit is out either refinancing or buying a home, because the super low interest rates means that rents are relatively much more expensive than a mortgage payment. And so that pushes up the prices of homes, particularly starter homes, which have been not what the building industry has been constructing up until this point, simply because of their higher margins in bigger homes. So The market has gone from being predicting a 1% growth to a 7% growth in 10 months. And it's across the markets. Yes, there's softness in New York and San Francisco, but just about everywhere else, and looking at the list of people on the call, there are people from all over the country, and everyone is probably experiencing the same thing in their markets. Multiple bids on homes, a lot of appreciation. And while that will be difficult for new entrants to the market, it will actually be quite good for our business, because as homeowners build equity in their homes, the chances of them performing or re-performing on their defaulted mortgage goes up a lot, because they don't want to be foreclosed out and lose an appreciating asset. And so are we, can everyone still see my screen, guys?
We lost the presentation, Paul.
I thought so. Yeah. Something just funny happened. Hold on, let me see, how do I get that back on? Share screen. Back?
Yep, we're back.
Okay, great. So if I use this, maybe. Interesting. So yeah, as I was saying, we're seeing appreciation across the whole market. And what's really interesting to me is where the value band of growth is really coming from. So these low-priced homes are growing about 50% faster, and in the high price, not really seeing that much growth at all, about 3 or 4%. But these low-priced homes up 6 or 7%. And I think we'll see an acceleration of that into 21, because the building companies have not been constructing low-priced homes. And that's where all the growth is in terms of home creation. So I think the starter home will see a lot of price increases in that area. And so that's where we've really been focusing this year. In terms of bidding, so I just pulled together this chart of all the bids we did throughout the year. We started repurchasing loans again, or purchasing loans again, just in the last quarter, in the third quarter. And for the year, we've bought 170 loans. We've bought performing and non-performing. Now, typically, we would not buy performing loans, but there was a dislocation in the market over the last several months where you could buy loans that were actually performing, paying every month for a price that was not that much more than a loan where the borrower wasn't paying. So we started buying some of those loans and saved ourselves the trouble of doing all the work of talking with the borrower and getting the deals done. So we bid on 23 portfolios this year, about 6,000 assets. And we won 170 loans, but you can't really look at it that way, I guess, because a lot of these will be pools of loans. So you either win the pool or you don't win the pool, or you win a portion of it. But we were very conservative in our bids. So our win ratio, which would typically be about 20 to 25%, well, it got down to 0% in quarter two, but we were very, very conservative on all of those. And we're now up actually about 38%, which is not bad, but it's quite a small base. But we'll be back in that 25% range. And I think the key is the underwriting, because you want to, at this time, stay away from industries that are affected by travel, leisure, those kind of industries. So we're trying to find loans where the borrower's income is more stable, and that they maybe lost their job some time ago and then managed to get a job in recent times, and we can start working with them to get them back on track. So to give you an example of one of those loans, or one of those, so we bought a pool. It was only $160,000, but one or two folks asked me to talk them through one of the actual deals, how it works. So this is a small pool of loans. The average property value is about $82,000. This is one of them. They were all in North Carolina, South Carolina, somewhere in New Jersey. And they came from a fund that was closing down. This was like the end of their operations. They were small, I guess you'd call them a mom and pop operation. We bought a number of their loans. We bought about 20% of their last 100 loans, maybe 10% of their last 100 loans. And the total balance on the loans was $253,000. So this is how much the borrowers owned. They paid for about 8 months. We bought the pool for $163,000, and the annual cash flow from the pool is $24,000. So it's producing about 15%. I think I rounded that up, it's 14 something, but about 15%. And the strategy is just to hold them until they've made 12 payments. And the reason for that is we paid about 70 cents for these loans, but those loans will be worth 80 cents after they've been seasoned, maybe even more than 80 cents after they've been seasoned, which means they pay month after month after month for 12 months. And that's our specialist sort of skill, is getting the borrower to pay every month. So in that year, we would collect about 22,000. And I've put an asterisk here because there's a very high likelihood that each borrower will not pay each month. Some people will miss some payments, and we will have to call them up and get them. We work with the loan servicer, but let's pretend there are no loan servicer. Someone has to call the borrower and get them back on track so that they can start performing again. We would resell those loans at about 80%, and this is illustrative. There's no guarantee that this will happen, but these would be typical numbers. So that generates $222,000 minus the $163 that we paid for them, generates $60,000 of gross profit, about 36%. And that's basically the way the business works. Most financial institutions would not be interested in buying loans against homes that were worth only $82,000. They would much rather be in the $200,000 or more. But because we run a very lean operation and a low cost operation, we can do things that, for example, a big bank cannot do because our costs are just so much lower. That's just one example. That was just six loans. Most of the other loans we bought were the typical non-performing loans, like I've shown you in the other webinars, where you're buying the house, just like I showed in the example, it's worth about $100,000 or $150,000, and we're paying 60 or 65 cents on the dollar for that, and then we work with the homeowner to get them back on track. In terms of outlook and what's happening next, what I think we'll see going into next year is that there will be an increased supply of non-performing and what we call spotty pay. So they pay some months, but not every month next year. That will increase. Today, we've 2 million loans that will end in their forbearance plans in March. So that's 2 million that are in forbearance and 1.3 million that are not, that are delinquent. That's 3.4 million loans in total. And I think a lot of them will come to the market, and everything we're hearing from the various people from whom we buy loans from, that they will become sellers next year. No one was selling this year. Normally, this would be a very, very busy time of year as people are cleaning house at year end. We're working on 2 or 3 trades, about 230, 240 loans. And I think the vast majority of them will close. And they're all scheduled to close on December 24th. So that'll be a happy holiday for me. But they'll probably close that following week, just at the 11th hour on the 30th or the 31st, depending on how the days fall. Some of those loans will self-cure, but many will not. I fully expect there to be another program, another stimulus program, maybe some sort of mortgage moratorium. But ultimately, these loans are not being paid and the balances are ticking up, and the borrowers are not saving the money they will need to bring those loans current in 6 months from now. So this is a good time to be doing what we're doing, which is raising money to buy more of them. I think that the real estate price appreciation will moderate. 7% is a record since the last crash. That can't keep going on. And as prices go up, the rent versus buy comparison becomes less attractive. And so people who are getting in now are getting great mortgage deals and will so for the next 30 years. And they'll ride some appreciation in the short term. And then prices will have increased so much that it won't be so attractive to buy. And maybe the market will get a little overheated again and there'll be a correction. But again, we try to buy at a discount so we don't get caught in the underwater trap. And so we're reopening the Reperformance Fund. We've been closed for 3 months, 2 or 3 months. We weren't taking any new funds in because it was so hard to buy loans, and we were paying interest out of our own pocket to investors for money that we weren't in fact using. We were just sitting on it. But we will have all of that money, or the vast majority of that money, deployed in the next 2.5 weeks. And so we're going to start, we'll open the fund again and start taking new investors in and go and buy more loans in the first quarter or second quarter of next year, as soon as that inventory starts to flow more freely. So that's, I think, everything I have for right now. What I'll do is I'll take any questions. If people want to jump off their re-engage their microphones, or maybe Albert, you can switch people back on, or there's a chat box